Hello and welcome to Fidelity Connects. I'm Rory Poole. For the past few years, artificial intelligence, or AI, has undoubtedly been the dominant conversation amongst investors globally. And while adoption and investment in this area may continue to dictate overall sentiment in the short term, it's important that investors don't lose sight of some of the less loved pockets of the market. One area that certainly fits that description is real estate. And as central banks globally continue to lower interest rates, investors may find opportunities, attractive entry points, and diversification in an asset class that is less sensitive to what's been dominating the recent news. Here to talk about real estate markets, where he's finding opportunities, and a new strategy that combines both private and public real estate is portfolio manager Don Newman. And before I introduce Don, just a reminder that today's webcast will have live French interpretation. Don, with that, welcome. Thanks for being a breath of fresh air today.
Yeah, thanks, Roy. Glad to be here.
Okay, as I mentioned, let's start with talking about real estate markets at a higher level.
Sure.
I guess, and probably any discussion around fundamentals within real estate probably starts with, painting a bit of a picture around supply and demand. So
Sure.
what does that look like to you right now?
I'd say let's start with sort of a bit of a background and a little bit of a history lesson. So if we go back a number of years, we go back to like 2021, sector did fantastically well. REITs were up something like, at least in the US, the REIT index was up like 40%. Perfect situation for real estate. We had demand, which was actually pretty good. And we had rates that were pinned at zero. So people were really hunting for yield, and valuation expanded on the sector. Now, while that was happening, it set the stage for a couple years that have been a little bit tough now. So we know after 2021, we hit 2022 and 2023. Rates went from 0 to 5%. And obviously, real estate is an interest rate sensitive sector and has to compete with other yield-bearing assets. So that put the sector under pressure for a couple years. And when you're in 2020, 21, when rates are pinned at zero, it was really easy to get financing. So a lot of construction projects started in 2021-ish, 22, 23, and have been coming on in 2024 and 25. So we had a couple years where you had increased supply and you're battling through higher interest rates. And then of course we got sort of the tariff shock at the start of the year. What's nice now is we're sitting on a sector where things really haven't moved in the last 6 years. The rest of the market has moved a lot. And there's kind of a line of sight now to supply. Interest rates are higher. The cost of producing any kind of building that you're making is gone up a ton. So supply is actually shrinking. Interest rates look like they've kind of peaked down, or at least being cut, and they've certainly been cut a lot in Canada on the short end, and the short end looks like they're coming down in the US. So you now have a case, so just broad brush, where supply is moderating. Demand is actually pretty good, and interest rates are becoming a little more of a tailwind than a headwind now. So it's an interesting time to actually start to look at the sector.
Yeah, sounds like a pretty good setup, all things considered, relative to, as you mentioned, a couple of years ago. So looking forward, some optimism to be had in that sense. Now, what about the other piece? So what about if we talk about kind of valuation, broadly speaking, because, supply and demand is one thing in terms of, again, painting that fundamental picture, but, where's real estate kind of trading nowadays? Again, recognizing, and we'll talk about the fact that you can't paint it all with one brush, but interested to hear your thoughts.
Yeah, we'll get into sort of the fact that this is, real estate's very heterogeneous. There's a whole bunch of different sectors we can look at, and we'll talk about that a little bit. But from the sort of broad brush valuation, you look at the entire market right now, and we've had a number of years of really good runs. Valuations certainly are fair to a little bit on the expensive side. Real estate's different, as I said, because of the headwinds. You've actually had valuations. You can look at it sort of almost across the board, and a lot of the companies are actually trading at pretty steep discounts to NAVs, which we say net asset values. And just like other stocks, when fundamentals are not extremely robust, what ends up happening is multiples compress. So if you look at different sectors across, and I'll use like US multifamily as an example, but the particular sector, because there's been headwinds, are trading at sort of multiples that you probably haven't seen, or on the low side, excluding like the financial crisis and COVID, about some of the lower multiples you've seen in like the last 20 years. So what's nice is if fundamentals do start to inflect sometime over the next year or two, what you end up seeing is you get the chance for not only earnings to improve, which they should as supply and demand tightens up, but you also get the chance for multiples to expand. And that's a really powerful sort of tool. You get a combination of you win on the earnings improving and you win on multiples expanding. And it's a little bit different than probably where the rest of the market is right now.
You mentioned, or you kind of hinted at the fact that, there's real estate, you've used the term before, it's a very heterogeneous area of the market, if you will. And certainly I think in 2025, like we've seen that divergence, right? We've got certain areas of the listed REIT market, like whether it's, healthcare, industrials in some instances that have really led. And then you have some of these areas that are still kind of shaking off that pandemic hangover, if you will, the offices of the world that maybe have trailed a little bit. But can you maybe just talk at large about like what is the kind of opportunity set within real estate?
So I think people often sort of get the questions, and living in Canada, you kind of think about, as a Canadian, you're very focused. Real estate means the Canadian housing market or the Canadian apartment market, and there's a little extra supply certainly, like in condos right now, and it's a bit of a sort of a tough market. That is not broad brush the entire market, and certainly not the market sort of I'm dealing with, which is I find sort of fascinating, because there's a whole bunch of subsectors in the real estate market for publicly traded REITs that don't share the same fundamentals. They're all driven broad, sort of on a higher level, a little bit by interest rates, but supply and demand fundamentals are quite different between the different sectors. So we'll sort of list them off, and I can go through them a little bit. Like you've got healthcare, you've got retail, you've got industrial, you've got multifamily, you've got single family, you've got data center, you've got storage, you've got hotels. There are a large number of different subsectors that actually have very different sort of characteristics. So we take right now, like strength, healthcare. The baby boom generation is getting to a point where I think the average person is now in their 70s. That is a huge age wave that is hitting a point where they need extra care. In some cases, you have your parents go into like some senior care or assisted living type things. And what's interesting is, like during the pandemic, no one would put their parents in there. You just wouldn't do it. So there was no extra supply that was created. At the same time, you could see this age wave coming and hitting, and demand is exploding, and there's no supply. So pricing power has been absolutely terrific, on top of occupancy going up, and the sector has been like an absolute winner this year. Industrial has started to perform a little bit better. We've seen companies say, listen, we've got this tariff thing, but at some point we actually got to run our company. We've got to make decisions again. And you're starting to see like leasing kind of pick up, and companies, like the whole idea of like reshoring into the US, and companies need more sort of distribution throughout the economy. Those companies are talking about sort of leasing picking up, occupancy picking up, and things becoming stronger. At the same time, there are sectors that have been impacted by supply, and the U.S. is a little bit ahead of Canada in terms of sort of like multifamily, or what we think of apartments. And huge amount of supply coming on in 24 and some in 25, but that supply's really started to dwindle now. And you can kind of see, you got this line of sight into, well, in some cases, you go to different regions and, well, supply's down 60% this year, or like new apartments brought to market, look to be down another 35 next year. And you can see the markets tightening up, and the supply and demand, when it tightens up, you'll get pricing power back, and the companies are trading really cheaply. So there's, I think, a lot of different opportunities that are outside of what people say, they look at every day in the newspaper. data center, like sort of really, really strong. The stocks haven't performed as well maybe as they should this year because they're having to put more CapEx in, but that CapEx eventually turns into growth in cash flow, and that should work. So a lot of opportunities out there. It's just, you just don't want to paint sort of broad brush the whole sector when there's in fact multiple different sectors in there in the sort of in the broad universe to look at.
Correct me if I'm wrong, but I think that there's like upwards of 250 listed REITs in North America.
Yeah, it's something. No. It's pretty big. It's pretty close to. It would be about around 250. I probably look at and skimming through like 150 to 200, and so it's not actually a small space. People just assume it's a couple REITs in Canada, a couple in the U.S. There is actually a very large constituency of real estate companies and publicly real estate companies to go through that all have different characteristics and potentially make for really interesting investments.
And I think the interesting thing for investors out there is, like, if you look at the composition of the S&P 500, REITs are like 2%, or something like that. So like, and we'll get to more of this in terms of our conversation, but like, if you want to make a kind of play towards diversification within a particular sector, in addition to what you mentioned, where there's so many different areas and pockets of the real estate market. And another thing, I'm just thinking of this now too, is that if I look at the composition of the REIT market, I think a lot of investors would be surprised that, it's not just all, these like dividend paying large cap stocks. Mm-hmm. There's actually a lot of opportunities, kind of, let's call it down cap or mid cap within that market, which from an active management standpoint is probably appealing as a manager, but also it means there's potentially some efficiencies.
Well, a lot of things sort of get overlooked. We're not talking about the $100 billion, $200 billion companies. We're talking about a few billion here and there. But there are companies that are around and have been around for a long time, and fundamentals are actually good, but they probably overlooked. And it's a nice combination of I run the dividend fund here, and it's like a nice combination of yield plus growth. You can still get 4 or 5% yields, and in some cases you get 5% growth, but in some cases some of the healthcare guys are growing 10, 15, 20%. And I use sort of one of the examples I like to use is. You look at retail. People think retail's sort of kind of a tough sector, right? Consumers a little bit tough right now. Maybe there's not as much to spend. But then you got to go dig and look at supply. There's been almost no retail put onto the market in the last decade. And if you talk to some of the CEOs, what they'll tell you is like, well, we can't because if we wanted to actually build something at current interest rates and current cost, we need 30 to 40% uplift in rents just to make this viable and to get a reasonable return. So at the same time, like retail's fine, but there's no supply. And no supply means, oh geez, all these companies, people were worried about e-commerce and that sort of moving away from retail. There's been almost no addition to actual like physical retail. And at the same time, e-commerce companies are realizing, wait a sec, we should actually have a physical presence here so people can come in and see the products. And it's become more sort of multi-strategy has become much more prevalent than just online. People actually want to see the products, go into a store, and then also have distribution from that store where you can maybe return and like actually get product. So retail is actually, and especially like grocery anchor retail, where people like need food, need to go to a grocery store, and then they go to a whole bunch of other needs-based thing, is actually a sort of an interesting sort of area that kind of flies under the radar.
Yeah, that's changed so quickly. Like a couple of years ago, it was bricks and mortar's dead, and now we're back to it, which probably just highlights the cyclicality that can exist within the real estate sector.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, Available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Let's talk about the new fund,
Sure.
Fidelity
Yeah,
Alternative
great.
Real Estate Trust. So this is a product that we launched for accredited investors
Yep.
in March of this year. You are the portfolio manager. It brings something a little different than I think some of your other mandates that you manage on behalf of Canadian investors. So why don't you talk a little bit about that and,
Sure.
and kind of your role as the PM?
Yeah, so I serve kind of a dual role. One is kind of the asset allocator. So what we tried to do is put together a fund where you've got kind of the best of both worlds. And it's about 70%, the baseline is going to be about 70% private. To give people access to, and it's Canadian, so Brookfield, we've been lucky enough to partner up with the best in the business on the private side in Brookfield, and we're buying private Canadian assets. And then on the public side, which is the area I run, we're going to do about 30% in REITs. And the idea there is sort of a combination of good risk reward, sort of steady growth in income, but also have a section of the fund that sort of has liquidity. I think under the baseline scenario, you'll probably see 70-30 be about where the fund sits, but I also do have the ability to flex it a little bit if one of the particular sides, the public or public, there's unusual opportunities and value there, and we can shift more to the private or more to the public.
Good stuff.
Now, and I guess, Rory, maybe like you've been on this, for people out there, Rory's actually been on this product a lot longer than I have from a product development standpoint. So maybe maybe you spend a minute or two just talking about like why Fidelity decided to come to sort of incubate this product and sort of take us through sort of the genesis of it.
Yeah, no, for sure, Don. Switch roles for a second. But I think that where I'd start with that is just the fact that, Fidelity is so great at managing, many different asset classes that exist out there. And you can see that by our line of funds, our offerings in Canada and really abroad. We don't do everything. However, we don't do everything in-house, I should say. So private real estate or direct real estate investing, and particularly within Canada, is one of those things. So to your point, we saw some potential long-term benefits of adding private real estate as an asset class to our various capabilities that we have on our shelf here in Canada. Why is that the case? I think you mentioned a few of the attractive attributes of real estate, generally speaking, but in particular within private real estate, lower volatility, has, fairly predictable, I think, cash flow generation over time, can be a great diversification piece to other areas of investors' portfolios. And so what we really wanted to do was partner with, Brookfield and kind of bring the biggest and the best, I would say, within the real estate space, particularly in Canada, that can leverage their entire platform to not just buy assets, but actually operate those assets as well, and have that at the ready for where we think it's of use within our broader lineup. And there's a few different places where it already is of use and is becoming of more use, as is the case within your fund. So we actually committed initially about $1 billion worth of capital for Brookfield to start investing on our behalf in various Canadian real estate assets. We've deployed about half of that thus far, and we'll continue to do so. And so you can see evidence of this within some of the funds that David Wolf and David Tolk manage, in particular the private investment portfolios. But we're also thinking of new ways and vehicles where investors can get more of a concentrated access to this capability, which is obviously the case within the Fidelity Alternative Real Estate Trust. I guess maybe just sticking on this kind of tangent we're on right now with respect to maybe Brookfield and Fidelity and this kind of strategic agreement we have. What do you think kind of some of the benefits are of not only working with Brookfield, but this product in particular to make it unique?
Yeah, no, that's a great question. So I guess the first one is just sort of obviously I talked a little bit about it. I think the timing's pretty good on this. You're not buying something at the top of the market. This is a brand new fund. So we were just starting this. It's a really good time to be Brookfield and going out and being the first call on assets that come to market. We went through a couple years of sort of valuations compressing. Brookfield is seeing more sort of opportunities out there at sort of attractive prices to go and pick up assets that are good, whether it be logistics, multifamily. We bought some student housing that should be really great assets for the next 10 to 20 years. So timing is one. Number two, this is something for an investor or sort of advisors that I think is really cool because you just can't do this at home. Okay, so Brookfield has just this global capability and the capability in Canada. They've been around and sort of dominating the Canadian real estate landscape for 50 years. If you're going to be selling an asset or doing a transaction in Canada, Brookfield is your first call. They have the transacting capability. They have the cash, partially from us and our investors because we believe in the product. And sourcing capability, financing capability, but it's just also sort of like the on the ground. If you're a logistics facility and there's some vacancy there, they've got the global sort of network to go and find and sort of boost up that vacancy. So maybe we can sort of find something that's not perfectly sort of 100% leased, but they can go out and already have people leased up. It's the ability to buy an operating platform and to do things, to go and buy a 500,000 square foot industrial building, to go and buy 800 units of apartments that hopefully now valuations are a little more attractive, and to be able to sort of run that and fix up the roofs and do all the operating things that you can't do on your own in a single product. So first call in real estate, best platform. They run the operating platform for you, and then on top of that, we put the sort of the Fidelity, turn over more rocks, do more work, sort of the equity research capabilities that most people will know us for in sort of Canada and around the world on the public side. So it's a wonderful marriage of the two. And you hopefully get a sort of a decent return at sort of lower volatility than the overall the overall market. So putting together, I think it's sort of like good timing, product you can't do for yourself, and a really good combination of sort of income and growth over time.
Yeah, no, that's a great summary, and I think just adding on to the point that you had with respect to like why Brookfield, and the question that you even had for me was simply it's developing like a private real estate business, and one that is kind of best in class, if you will, and developing scale within that area. That's tough, and that involves a lot of investment time.
Yeah.
And as a result of that, I think for our purposes within this product, the stars kind of align to utilize a great partner like Brookfield. You talked a lot about the private portion of the new fund here. Yep. I actually want to quickly just ask you more so about the sleeve that you run in listed REITs.
Yep.
So you have an investment universe, broadly speaking, it's like a cap-weighted North American REIT kind of index. Maybe your viewers would be curious to know a little bit, given the fact that you can purchase those REITs in Canada or the US. Maybe a two-parted question.
Yep.
One is, are there specific differences between REITs that are north of the border versus those that are south of the border? And two, if we get there, is how do you look at a REIT differently than you would look at like a normal dividend paying stock? I say normal.
Yeah.
You know what I mean?
So The answer is the business models are converging a little bit. Canada very much used to be an income market. That sort of view, I think, has changed. Certainly as valuations have come down, people don't like, or management teams can't go to the equity markets because you're not going to raise money at a 20% discount to NAV because it's just dilutive to shareholders. The US market has been a little more of a sort of a growth plus income market. So lower payout, they run with lower payout ratios, so you have cash left over to kind of reinvest, do acquisitions, and run with lower leverage. And that seems to be the business model that has kind of won out. And sort of the Canadian firms are kind of more gravitating towards what sort of the U.S. model kind of looks like. So I'm sorry, what the second part?
No, just high level, like how you approach a REIT versus.
So it's actually fairly similar. Like the metrics are all different. Like FFO, fund from operations, AFFO, which is basically cash flow, subtract capex. You're looking at kind of like NOIs and cap rates. And anyway, there's a whole bunch of different sort of lingo that goes into it. But at the end of the day, what I'm kind of doing is very similar to what I do in dividend fund, because I've actually done it in dividend and dividend plus for the last 20 years in the REIT portion. It's going and looking at a subsector of the market, finding sort of the sub-industry, where are we finding the best supply and demand? Where are the fundamentals the best? What's going to grow? What can grow cash flow the most? And then diving in and finding, okay, that sort of industry or sub-industry, then going on and looking at like the company. Okay, what's the best company in the industry? Who's the best management team? Who actually has the best assets that I want to ride for the sort of a long period of time? And sort of, so it's industry, find the best company in it, and then sort of marry that with valuation. Okay, well, I found sort of the best subsection industry. I found the best company. Now let's find, can I buy it at a reasonable valuation? If I can put the three together, and then I get this sort of reasonable yield plus growth on it. And I always think of things as yield plus growth plus valuation, same as I would in dividend. I just do it in the sort of the real estate world. We find a sort of an attractive opportunity, and if they kind of meet the hurdle of good yield, good growth, and reasonable valuation, they go in the fund.
Good stuff. Well, it sounds like, with your overview of how you're seeing the market right now, that approach, and then obviously all the resources you have as it relates to this fund and otherwise, hopefully should be a good next couple of years in that sense.
Thanks, Rory. I'm excited. I'm excited about what sort of the prospects for the next couple of years. So,
yeah, we are too. And I guess just on that note, like a bit of a service announcement, if you will, for those that are watching, just in the sense that these offering memorandum accredited investor vehicles, as many I think advisors know, they take a little bit more time to get approved on various dealer shelves. So I would encourage you that if you are interested in the Fidelity Alternative Real Estate Trust, please talk to your Fidelity sales representative or anyone really who works in manager research at the dealer. We have many resources here at Fidelity that can help with that process. But it's a little bit different than punching in the ticker like you would typically do on a mutual fund or an ETF. With that said, Don, thanks so much for joining us today.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.